Hello everybody, welcome to the first core content lecture of 2026. This one will be focusing on quarterly theory basics. So getting started into the table of contents. So this video will be split into three separate parts or three separate pieces of information. Number one being cycle alignment. Number two being and dealing with true opens. And finally, number three, sequential SMT. So these three things right here are very crucial and honestly the foundation of quarterly theory as a whole. If you don't understand these things, while they are very, very simple, they are extremely, extremely effective. So if you don't understand them, heading forward, then it is very likely that you will be lost. So everything said in this video and all of the text written on the screen is extremely important, and everything should be written down, right? You don't just want to go through these videos watching them like it's a Netflix series, because everything I put inside of these core content videos is the raw information, straight to the point. There's no riddles, there's no rhymes, it's just as it is. But so getting started with cycle alignment. Firstly, you have to understand the basis of quarterly theory and knowing that everything in price is fractal. So if we think for a second, what is a quarter? Well, a quarter is a fourth of something. And if you have 4 quarters, that makes a whole. Now you're probably wondering, okay, well, how does this tie into trading? Well, it doesn't necessarily tie into trading, but it does tie into time. So there are 4 weeks within 1 month. So each week is a quarter and the entire month is a whole. There are 4 days in 1 week, excluding Friday. So each day of the week is a quarter, and an entire week is a whole. And there are 4 sessions within 1 day. So each session is a quarter, and each day is a whole. Now digging a little bit deeper, within the monthly cycle, you have, week 1, week 2, week 3, and week 4. So the monthly cycle deals with weekly quarters, and then the weekly cycle is Monday, Tuesday, Wednesday, and Thursday. So the weekly cycle deals with days of the week. And then you have the daily cycle, which is Asia session, London session, the New York primary session, and the New York afternoon session. So the daily cycle deals with the sessions of the day. Each session makes up a quarter, and remember, a day is a whole, so that's why we call it the daily cycle, and then so on and so forth for all of the other cycles. Now moving to the next slide, we have each quarter can reflect a candle. Now, while this might seem very simple, it can be very, very beneficial for spotting things or spotting a particular thing that we will look at later on in this lecture. But moving forward, a monthly cycle quarter can reflect a weekly candle. A daily cycle quarter can reflect a 6-hour candle. And a weekly cycle quarter can reflect a daily candle. So doing a little bit of recap of what we learned about cycle alignment. Anything in the future I say about the weekly cycle, your mind should automatically jump to days of the week or a daily candle. If I ever say anything about, a monthly cycle, your mind should automatically jump to weeks of the month or weekly candles, right? So on and so forth. But now we are going to dive into true opens. So the true open serves as a timed premium and discount at the beginning of a cycle's lifespan. So what does this mean? Well, so let's say the true open has occurred and price only trades above the true open and never trades below it. The higher it trades above the true open, the deeper of a premium price is in, and then vice versa. If the true open occurs and then price just trades lower and lower and lower and lower with never trading above the true open, that means it's trading into a deeper discount as it's trading lower. And if you don't know what premium and discount is, just think of overbought or oversold, right? For a premium, it's overbought, and for a discount, it is oversold. The true open is always the opening price of Q2 in any given cycle. So as soon as Q2 opens up in any cycle, that is the true open, right? Very straightforward. And lastly, the true open becomes irrelevant once price creates a respective crack in correlation, which we will talk about, like I said, later on in this lecture. But that is a very, very, very important note. And that is something that a lot of people don't know about, right? So there are times when you want to see something occur with the true open, and there are times that you don't. And this is how you filter that, right? If price creates a respective crack in correlation to the true open, then and only then does it become irrelevant. All right, and now digging deeper. So in a bullish environment, price should trade below the true open before continuing higher. And in a bearish environment, price should trade above the true open before continuing lower. So a quick example of that, as we can see, here we have a chart example. So this would be Q1, this is Q2, this is Q3, and this is Q4. All right, it doesn't matter what cycle we're looking on, because remember, everything in price is what? Fractal. So as we can see here, price opens up in Q1, trades slightly lower, but then Q2 occurs, and now we have the true open identified, and price trades below the true open. Then Q3 opens up, and price begins expanding higher and trading higher. And no, this is not hindsight. If you wish to go back and look at this for yourself, for the Tier 3 members, this was Wednesday, January 7th on the NASDAQ, and as you guys know in the tape reading, we were anticipating higher prices. But now looking at sequential SMT. So SMT alone is defined by a crack in correlation between highs or lows among two correlated assets. So many of you already know SMT as it is. Now, if you don't know SMT, right, the abbreviation doesn't really mean anything. People argue on what the abbreviation means, but we don't care about that. We're not here to sit around and textbook people and seem smarter than the other person, right? We're here to use concepts and trade as efficiently and effectively as possible. But let's say on the S&P 500, Monday prints a high, and on the NASDAQ, Monday prints that same high. And then we roll around to the following day, being Tuesday, the S&P 500 takes out Monday's high, whilst the NASDAQ fails to take out Monday's high. That would be an SMT between highs, right? A cracking correlation. Two closely correlated assets where the scenario is one asset does one thing and the other asset doesn't, creating, a crack in correlation. Quote unquote sequential SMT deals with the specific high or low of the previous traded quarter, adding immense probability. So this is where the term sequential comes from, right? Because you're thinking within a sequence. So you're still looking at highs and lows, but you're looking at only specific highs and lows. So the highest high and the lowest low of the previous quarter is what you're focusing on. And now looking at a diagram, we can see the box on the left would be a quarter, and then the box on the right would be a quarter, and that vertical line would be separating the quarters. So let's say in that top left box, this is an asset providing price data. And let's say in that bottom left box, a different asset that is closely correlated is providing price data as well. So looking at this, we can see that the high of this quarter here on both assets would be this high right here. So this is the high of the quarter. This is the important high that we're focusing on. As soon as this quarter closes and the next quarter opens up, right, we're immediately drawn to seeing of how price treats these highs here on both respective assets. So if we load the diagram a little bit more, we can see that now in the following quarter, being this quarter here, price provided data, right? This high here was the high of the following quarter, being this one, for asset 1, and this high here on asset 2 was formed here. Now, what is special about this? Well, if we look closer and compare both of the quarters, we can see that with asset 1, the following quarter took out the previous quarter's high, being this high right here, and on asset number 2, we can see the following quarter did not take out this high right here. So this is called a failure swing due to the fact that it failed to take out this high. So this would be an example of sequential SMT. And this is very, very, very high probability for reversals. And this is the key signature that we always look for, every single day, every single week, every single month. But anyways, with that being said, hopefully you all found this one insightful. I'll speak with you all again soon. Good luck and good trading.